This study objective deals with depreciation, and it's kind of a review of things we started learning back in Chapter 4. I'm continuing on with the same piece of equipment that we capitalized in the last video for $95,000, and now I'm estimating that equipment will have a 10-year life. So I'm going to depreciate 1/10, or $9,500, every year over the asset's life. When you record your annual depreciation, you debit depreciation expense. That goes on the income statement. And you credit accumulated depreciation. Do you remember what that is? It goes on the asset section of your balance sheet. But this asset has an abnormal credit balance. So what is that called? Yeah, it's a contra asset. There are two generally accepted accounting principles that relate to depreciation. Sometimes students get these mixed up. The matching principle is really why we record depreciation. If you have this asset that you're going to be using for 10 years, getting benefit from it, earning revenues from it for 10 years, you don't want to expense the whole thing away in year 1. What we want to do is match all the revenues over that 10-year period with some amount of expense every year during the 10 years. So the whole purpose of depreciation is really just to spread or allocate the cost of that asset over its useful life in accordance with the matching principle. That's why we depreciate. Now, what about the cost principle? We first learned about this back in Chapter 2. The cost principle says when you buy an asset, record it at cost, and then you also have to keep that asset on your books at cost as long as you physically have it. These two rules are almost in conflict with one another. The matching principle says over the asset's life you have to expense it away. The cost principle, on the other hand, says, yeah, but while you're expensing it away, you can't reduce the asset account. Well, how can we expense it away without taking the asset off the books? In the journal entry we just looked at, you expense a certain amount every year, but instead of taking it away directly from the asset, you go through the contra account. This contra account is subtracted from equipment on the balance sheet to arrive at the book value. This allows you to continue to show the entire $95,000 in the equipment account during the entire 10 years that you have it. The accumulated account will be building up and the book value shrinking, but the cost of the asset will always remain in the equipment account in accordance with the cost principle. Now, to help you further review some of these depreciation concepts, I posted for you this sheet, which hopefully looks kind of familiar. It was a homework sheet that you had back in Chapter 4. And I'd like you to review this just for basic concepts. Again, why do we record depreciation? You're simply allocating the cost over its useful life. Which rule of GAAP tells us we have to depreciate? The matching principle. Name a couple assets that would be depreciated. We have a new one now that we just learned about, and that would be land improvements. That's depreciated too. And review again, why is it that we don't depreciate land? Do we depreciate supplies? No, we don't. They physically disappear, so you can take the supplies account down directly as you use them up. Which rule says that we have to go through accumulated depreciation rather than deducting dollars from the equipment directly? That would be our cost principle. And then also go back and look at a balance sheet. Make sure you can see where accumulated depreciation shows up. Right below the asset on the balance sheet. Book value is another term you need to remember, and that's calculated as the asset's cost minus its accumulated depreciation. This does not represent the asset's value or market worth at any point in time, because the market value of an asset could be rising, could be falling. Depreciation is just spreading the asset's cost over its useful life. Book value is how much you have not depreciated yet, how much you have left to go.